Financial Intelligence by Karen Berman and Joe Knight. There was once a man who made Wall Street cheer and corporate boards tremble. His nickname? Chainsaw Al Dunlap. Back in the 90s, he was the ultimate corporate superhero, swooping in to save struggling companies by slashing costs and sending stock prices into orbit. When he took over at Sunbeam, the appliance maker, investors went absolutely wild. The stock jumped more than 50% just on the news that he'd been hired. And once again, he seemed to be working his trademark magic. He cut the workforce in half, profits soared, and the stock price punched through the ceiling. From the outside, it looked like another stunning turnaround. Sunbeam appeared stronger, more profitable, and more valuable than ever before. But one analyst, a guy named Andrew Shore, couldn't shake this nagging feeling that something was wrong. The numbers looked almost too perfect. So he started digging deeper. He wasn't dazzled by the headlines or the hype. Instead, he dove into the financial statements, those boring black and white documents that most people skip right over. And buried in those pages, he discovered something disturbing. A story that contradicted everything Chainsaw Al was telling the world. He calculated one simple ratio, a number that revealed how long Sunbeam was taking to collect money from its customers. And that number was ridiculously, outrageously high. It was a glaring red flag, one tiny thread that, when he pulled it, unraveled a massive web of deception that would eventually drag the company into bankruptcy and destroy a legendary CEO's career. What exactly did he see? How could one number, tucked away in a financial report, expose a lie that had fooled almost everyone? The answer to that question unlocks a kind of secret language, the language of business itself. It's a language that can feel pretty intimidating, packed with strange terms like accounts receivable, amortization, and the mysterious-sounding abbreviation of the day. But here's the thing. This language isn't just for accountants and Wall Street hotshots. It's a language you can actually learn, and learning it will give you a genuine advantage in your career, in your investments, and in understanding how the world really operates. That's the powerful promise behind the book we're diving into today, Financial Intelligence by Karen Berman and Joe Knight. This isn't another dry accounting textbook that'll put you to sleep. It's a guide to understanding what the numbers actually mean. It pulls back the curtain on the world of finance and reveals something surprising. Finance is as much an art as it is a science. By the time we're done today, you won't just know the difference between an income statement and a balance sheet. You'll understand the story the numbers are telling. You'll learn to spot the assumptions, the estimates, and even the hidden biases that can lurk in any financial report. You'll discover why some companies that look wildly profitable on paper can suddenly go broke. This skill will empower you to ask sharper questions, make better decisions, and see the business world with a clarity most people never achieve. So let's get started. If you've ever glanced at a financial report, you've probably seen row after row of numbers that look rock solid, objective, and absolute. Black and white. Right or wrong. We learn in school that math is the one place where there's always a correct answer. 2 plus 2 always equals 4, right? But here's the first and maybe the most mind-bending lesson from financial intelligence. When it comes to business, numbers aren't always what they seem. Karen Berman and Joe Knight want you to understand a profound secret that every chief financial officer knows. Profit is an estimate. Let that sink in for a second. Profit is an estimate. How is that even possible? It's because accounting isn't just about counting beans. It's about telling the story of a company's performance over time. And to tell that story, accountants have to make judgment calls. They rely on assumptions, estimates, and rules that are absolutely open to interpretation. This is what the authors call the art of finance. Think about one of the most basic questions a business faces. When is a sale actually a sale? You might think it's when the cash hits the bank account, but that's not how it works. Accountants follow something called revenue recognition. Generally, a sale gets recorded or recognized when the product or service has been delivered to the customer. Now that sounds simple enough. But what if a company sells complex equipment that also includes a 4-year service and maintenance contract? That's exactly what Xerox did. They'd sell a copier on a long-term lease. So how much of that total contract price was for the machine itself, which was delivered today, versus the service they'd provide over the next 4 years? This is where the art comes in. The accountants have to make a judgment call. Do they count 50% of the revenue now? 75%? At one point, Xerox, desperate to keep their profits looking good, started booking more and more of that future revenue up front. They were recognizing revenue for services they hadn't even performed yet. They stretched the rules of the art until they snapped, eventually leading to a massive scandal where they were caught improperly booking billions of dollars in sales. This is a dramatic example, sure, but similar things happen in smaller ways every single day. The numbers you see on a financial report are shaped by dozens of these little artistic decisions. Here's another one. Depreciation. Imagine a company buys a big, expensive garbage truck for $150,000. It would be totally unfair to count that entire cost against just 1 month's profits. The truck's going to haul trash and help the company earn money for years to come. So accountants depreciate it. They spread the cost out over the truck's useful life. But what is its useful life? 8 years? 10? 12? The industry standard might be 8 to 10 years. But what if a company's executives, desperate to make their profits look higher, suddenly decide their trucks are special? That they'll last for 14 years? That's exactly what the company Waste Management did. By extending the depreciation schedule on their massive fleet of trucks, and even their dumpsters, they reduced the amount of expense they recorded each year. Less expense automatically means more profit. It was an accounting trick, a stroke of financial artistry that artificially inflated their profits by hundreds of millions of dollars before the whole scheme came crashing down. These stories aren't just about fraud. They reveal something fundamental. The numbers on a financial statement are the result of assumptions and estimates. And wherever there are assumptions and estimates, there's potential for bias. Not necessarily evil mustache-twirling bias, but a slant. The numbers might be nudged in one direction or another, depending on the optimism, pessimism, or motivations of the people putting them together. Being financially intelligent doesn't mean becoming an accountant. It means understanding this art. It means knowing that the numbers aren't gospel truth. They're a story. And your job is to learn how to read that story, ask the right questions, and figure out where the story might be bending reality. So how do we start reading these stories? Well, every business tells 3 main stories. They're called the 3 financial statements: the income statement, the balance sheet, and the cash flow statement. If you can understand these 3 stories, you can understand pretty much any business. Let's start with the first story, the income statement. Think of the income statement as a report card. It shows how a company performed over a specific chunk of time, whether that's a month, a quarter, or a year. It has a pretty straightforward structure. Right at the top, you've got revenue, also called sales. This is the total value of all the products or services the company delivered to customers during that period. Then you subtract the costs directly tied to making that product or delivering that service. This is called cost of goods sold, or just COGS for short. If you run a lemonade stand, your revenue is what you earned from selling cups of lemonade. Your COGS would be what you paid for the lemons, sugar, and cups. When you subtract COGS from revenue, you get your first level of profit, gross profit. This number is absolutely critical. It tells you the basic profitability of what you're selling. If your gross profit is low or, heaven forbid, negative, you're in serious trouble. It means you're spending almost as much, or more, to make your product as you're selling it for. Next, you subtract all the other costs of running the business, the expenses that aren't directly tied to the product itself. These are your operating expenses. This includes things like salaries for your marketing team, your HR department, office rent, and, yes, depreciation. After you subtract those, you get your next level of profit, operating profit. This is a really important number because it shows the profit a company makes from its core business operations, before things like interest on loans or taxes come into play. It's a fantastic measure of how well the company is actually being managed. Finally, after you subtract interest and taxes, you arrive at the famous bottom line: net profit. This is what's left over after absolutely every expense has been paid. When people ask, what's the bottom line, they're almost always talking about net profit. This is the number that gets splashed across the news, the number Wall Street obsesses over. But as we now know, this number is an estimate. It's the result of all those artistic judgments we talked about earlier. And that brings us to the second, and arguably more revealing story a business tells: the balance sheet. If the income statement is a report card over time, the balance sheet is a snapshot. It's a photograph of the company's financial health on one specific day. It answers two simple questions: what does the company own, and what does it owe? What a company owns is called its assets. This includes everything from cash in the bank, to inventory sitting in the warehouse, to buildings, machinery, and trucks. It also includes something called accounts receivable, which is money that customers owe the company for products they've already received but haven't paid for yet. What a company owes is called its liabilities. This includes loans from the bank and also accounts payable, which is money the company owes to its own suppliers for materials it's received but hasn't paid for yet. The difference between what a company owns and what it owes is its equity. This is sometimes called its book value or net worth. It represents the shareholders' stake in the company according to accounting rules. And this leads to the fundamental accounting equation, the one rule that governs the entire balance sheet: assets equal liabilities plus equity. This is why it's called a balance sheet. It always has to balance. Think about it this way: everything a company owns, its assets, had to be paid for somehow. Where did the money come from? It either came from borrowing money, that's liabilities, or from money invested by the owners, that's equity. There's no other option. So the two sides of the equation must always be equal. The balance sheet reveals the strength and structure of a company. A company loaded with assets and very little debt is generally in a strong position. A company drowning in debt compared to its equity might be risky. It's like someone who owns a mansion but has a massive mortgage and almost no cash. They look rich, but they might be financially fragile. Experienced investors often look at the balance sheet before they even glance at the income statement. Why? Because while the income statement tells you about recent performance, the balance sheet tells you about long-term stability. It shows the cumulative result of every profit and every loss the company has ever experienced. But even the balance sheet has its artistic elements. Remember those garbage trucks from Waste Management? The value of those trucks on the balance sheet depended entirely on the depreciation schedule the company chose. And many of a company's most valuable assets, like its brand reputation or its brilliant team of engineers, don't even appear on the balance sheet at all. So we've got the story of performance, that's the income statement, and the story of strength, the balance sheet. But there's a third story, and this one might be the most important of all. It's the cash flow statement. This is the reality check. Here's one of the most critical lessons in all of business, a concept that trips up so many people. Profit is not the same as cash. You can be the most profitable company in the world on paper and still go bankrupt because you don't have enough cash to pay your bills. This seems impossible, but it happens constantly. The authors tell a brilliant story using two fictional startups that makes this crystal clear. First, there's Sweet Dreams Bakery. It's a new business selling cakes to grocery stores. Sales are absolutely booming. In the first month, they hit $20,000 in sales. Second month, $30,000. By the third month, they're at $45,000. Their income statement looks fantastic. After a tiny loss in the first month, they're making healthy profits. The owner should be popping champagne, right? But there's a major problem. Her customers, the grocery stores, take 60 days to pay their bills. Meanwhile, she has to pay her suppliers for flour and sugar within 30 days. Let's follow the cash. In January, she has $20,000 in sales, but zero cash comes in. All of it sits in accounts receivable. But she still has to pay operating expenses like rent and utilities. Her starting cash of $10,000 evaporates by month's end. In February, sales are even better, but she still hasn't collected any cash from January's sales. Her accounts receivable keep piling up. Meanwhile, the bill for January's flour and sugar is now due. She has to pay her suppliers and cover another month of operating expenses. She's got no cash coming in and tons of cash going out. She's deep in the red, cash-wise. By the end of March, even though she's wildly profitable on her income statement, her bank account is massively overdrawn. The business is growing so fast that its need for cash is outstripping its ability to collect it. If she can't secure a loan, this profitable, growing business will die. It will simply run out of cash. Now consider the opposite case. Fine Apparel, a new clothing store. They also have growing sales, but their income statement doesn't look so hot. Because of high rent and other costs, they're losing money every month. Their net profit is negative, but their cash situation is beautiful. Why? Because they're a retailer. Customers pay with cash or credit card immediately, so cash flows in the door right away. And let's say they negotiated a sweet deal with their clothing suppliers and don't have to pay them for 60 days. So in January, they get $50,000 in cash from sales. They have to pay rent and salaries, but they don't have to pay for the clothes yet. Their bank balance grows. In February, it grows even more. By the end of March, even though the company is unprofitable on paper, it's sitting on a huge pile of cash. These two stories perfectly illustrate the difference between profit and cash. Sweet Dreams was profitable but had no cash. Fine Apparel was unprofitable but flush with cash. Which company would you rather be? In the short term, you'd definitely rather be Fine Apparel. You can survive without profit for a while. You absolutely cannot survive for a single day without cash. Cash is the oxygen of a business. When it runs out, the business dies instantly. This is why the cash flow statement is the ultimate reality check. It doesn't care about assumptions or estimates. It only tracks real money moving in and out of the company's bank account. It's broken down into 3 simple categories. First, cash from operations. This is cash generated by the core business, selling products and paying employees and suppliers. A healthy company should have strong, positive cash flow from operations. Second, cash from investing. This is cash used to buy or sell long-term assets, like new machinery or buildings. If this number is negative, it's often actually a good sign because it means the company is investing in its future. Third, cash from financing. This is cash from borrowing money from banks or receiving money from investors. It also includes cash paid out to repay loans or pay dividends to shareholders. Of the 3, cash from operations is the one that really tells you about the health of the underlying business. It shows whether the company can turn its profits into actual cash. As the legendary investor Warren Buffett has said for decades, cash is king. So now we understand the 3 great stories of business: performance, that's the income statement; strength, the balance sheet; and survival, the cash flow statement. But being financially intelligent isn't just about reading these stories. It's about analyzing them. It's about looking at the numbers and spotting the patterns, the trends, and the warning signs. And for that, we have a powerful set of tools called ratios. Ratios are the secret to reading between the lines. A number like $10 million in profit doesn't mean anything by itself. Is that good or bad? It depends. Compared to what? Ratios provide that comparison. They show the relationship between 2 numbers, and that relationship often tells a much deeper story than either number alone. Let's go back to the Chainsaw Al Dunlap story at Sunbeam. The ratio that analyst Andrew Shore calculated was called Days Sales Outstanding, or DSO. It's an efficiency ratio that measures, on average, how many days it takes for a company to collect payment after making a sale. You calculate it by taking accounts receivable from the balance sheet and dividing it by daily revenue. Sunbeam's DSO was shockingly high. It meant that even though they were reporting massive sales, they weren't collecting the cash. Why? Because they'd made these shady bill-and-hold deals, essentially pushing future sales into the current quarter. They'd sold grills in the middle of winter, but the retailers weren't going to pay for them for months. That high DSO was the clue that something was deeply wrong with the quality of their sales. It was the loose thread that unraveled the entire story. This is the power of ratios. There are dozens of them, but you only need to know a handful to get a solid sense of a company's health. They fall into a few main categories. Profitability ratios tell you how good a company is at generating profit. The most common one is net profit margin. It's just net profit divided by revenue. It answers the question, for every dollar of sales, how many cents are left over as pure profit after all expenses are paid? Liquidity ratios tell you if a company can pay its short-term bills. The current ratio compares current assets, things that'll be cash within a year, to current liabilities, bills due within a year. A ratio of 2 to 1 is generally considered healthy. It means you have $2 of incoming resources for every $1 of outgoing obligations. If that ratio gets close to 1, it's a serious warning sign. Leverage ratios show how much a company relies on debt. The debt-to-equity ratio compares a company's total liabilities to its shareholders' equity. A high ratio means the company is heavily financed by debt, which can be risky. And then there are efficiency ratios like the DSO we just talked about. Another huge one is inventory turnover. This measures how quickly a company sells its inventory. High turnover is fantastic. It means products aren't sitting on shelves for long, tying up cash. Walmart is an absolute master of this. Their inventory turnover is incredibly high, which is a key reason they can keep their prices so low. Learning these ratios is like a doctor learning to read blood test results. Each number tells you something about the health of the patient. One number might be fine, but a combination of several numbers trending in the wrong direction can signal serious illness. Now, once you understand how to measure a business's health, you can start thinking about how to improve it. This is where we get into the really powerful practical applications of financial intelligence. Two of the most important concepts are return on investment, or ROI, and working capital management. ROI is all about making smart decisions for the future. Whenever a company considers a big new project, like building a new factory, launching a new product, or buying new equipment, it has to ask a fundamental question. If we spend this money today, will we get enough of a return in the future to make it worthwhile? This involves a concept called the time value of money, which is just a fancy way of saying $1 today is worth more than $1 tomorrow. Why? Because you can invest today's dollar and earn interest on it. So to evaluate a project properly, you can't just add up the future cash flows it'll generate. You have to discount them to figure out what they're worth in today's dollars. This is called calculating net present value, or NPV. If the NPV is positive, it means the project will earn more than the company's minimum required rate of return. And it's probably a good investment. But perhaps the most powerful and immediate way a manager can improve a company's financial health is through working capital management. This sounds complicated, but it's what the authors call the magic of managing the balance sheet. Working capital is essentially the money tied up in the day-to-day operations of the business. It's calculated as current assets minus current liabilities. More simply, it's the cash needed to bridge the gap between paying your suppliers and collecting from your customers. And this brings us to the cash conversion cycle. Imagine a clock. The clock starts ticking the moment you pay your suppliers for raw materials. It keeps ticking as those materials sit in inventory, as they're turned into a product, and as that finished product sits waiting to be sold. It continues ticking after you sell the product, while you wait for your customer to pay you. The clock only stops when the customer's cash finally lands in your bank account. The length of time that clock is ticking is your cash conversion cycle. The formula is simple. It's your days in inventory, how long stuff sits around, plus your days sales outstanding, how long it takes to get paid, minus your days payable outstanding, how long you take to pay your own suppliers. The shorter your cash conversion cycle, the less cash your business needs to operate. It's a measure of incredible efficiency. And here's the beautiful part. This is something every single person in a company can affect. Engineers can design products with fewer, more standard parts, reducing inventory. The production team can reduce machine downtime, which also cuts inventory. The sales team can be more disciplined about payment terms they offer customers, reducing DSO. The customer service team can make sure invoices are accurate and sent out on time, also reducing DSO. By making small improvements in these areas, a company can magically free up huge amounts of cash without selling a single extra product. It's like finding money that was hidden inside the company all along. This is the real power of financial intelligence. It's not just about understanding reports. It's about understanding the system, the flow of money through the business, and knowing which levers to pull to make that system run better, faster, and more efficiently. This knowledge transforms you from just an employee doing assigned tasks into a genuine business partner, someone who sees the big picture, understands what creates value, and knows how to contribute to the long-term health and success of the enterprise. And that, in the end, is what financial intelligence is all about. So what do we take away from all of this? When you first pick up a book called Financial Intelligence, you might brace yourself for a difficult, technical slog. But what Karen Berman and Joe Knight have done is something pretty remarkable. They've demystified the world of finance and made it accessible, even fascinating. The most powerful lesson for me is the shift in perspective, from seeing finance as a rigid set of rules to seeing it as an art. The idea that profit is an estimate is genuinely a game changer. It frees you from being intimidated by the numbers and empowers you to ask questions. It teaches you to be a critical thinker, not just a passive receiver of information. When you see a report now, you can ask, what are the assumptions behind this number? What story is it trying to tell me? And what might it be leaving out? The second profound takeaway is the stark, undeniable difference between profit and cash. The story of the profitable bakery going bankrupt while the unprofitable clothing store swims in cash is like a parable for the modern business world. It's a lesson so many entrepreneurs and even seasoned executives learn the hard way. Understanding that cash is the lifeblood, the oxygen of a business, is foundational wisdom. It helps you understand why a company might celebrate record profits while also announcing a hiring freeze. It's not a contradiction. It's the reality of the cash conversion cycle. What I love most about this book is its relentless practicality. It's not just theory, it's about action. The concepts of working capital management, of pulling the levers of DSO, inventory, and DPO are things people at all levels of an organization can influence. It connects the daily work of an engineer, a salesperson, or a customer service representative directly to the financial health of the company. It shows you don't have to be the CFO to have a massive impact on cash flow. So how can you start applying these lessons today? Here are a few simple actions. First, get curious about your own organization. If you work for a publicly traded company, go to its website and find the Investor Relations section. Download the latest annual report. Don't try to read the whole thing. Just find the 3 financial statements: the consolidated income statement, the balance sheet, and the statement of cash flows. Just look at them. See if you can identify the big numbers like revenue, net profit, total assets, and cash from operations. See how they've changed from the previous year. You won't understand everything, but you'll have taken the first step. You'll be looking at the source code of your business. Second, ask one simple question at your next team meeting. What is the single most important number for our team to focus on to help the company succeed? This question starts a conversation. It forces discussion about what truly matters and how your team's work connects to the bigger picture. You might be surprised by the answer, and the discussion itself is incredibly valuable. And third, start thinking in terms of cash. Before you propose a new project or expense, ask yourself not just what's the benefit, but also what's the cash impact. When will cash go out, and when can we expect to see a cash return? This simple shift in mindset aligns your thinking with the most successful business leaders. Ultimately, financial intelligence is about more than numbers. It's about empowerment. It's a book that tells you the language of business isn't some secret code reserved for the elite. It's a language anyone can learn. And by learning it, you gain the confidence and competence to play a bigger role in the game, to contribute more meaningfully, and to build a more successful career and a more prosperous future for yourself and the organizations you're part of. That was a summary of Financial Intelligence by Karen Berman and Joe Knight. We've touched on the core ideas today, but I'll be honest, a summary can only ever be a map. The real treasure is found when you journey through the book yourself. It's in the quiet moments, when a particular story or simple phrase connects with your own experience in unexpected ways. This summary is designed to help you decide if this book is worth your time. If anything we've talked about today has lit a spark of curiosity in you, I encourage you to grab a copy. Reading it isn't just about learning. It's an experience that can genuinely change the way you see the world of business and your place within it. There's a link to the book in the description below. Also, if you found this summary valuable, please take a moment to click that like button and subscribe to the channel. It lets us know we're on the right track and ensures you won't miss our next journey into another life-changing book from the Billionaire's Bookshelf. Let's keep growing together.